Good morning, ladies and gentlemen. My name is Blair Pleash. I'm a partner in the Insolvency and Reconstruction Division of Hall Chadwick. Welcome to our breakfast seminar today, which will deal with economic insights with an agribusiness flavour. Today's session is being run in conjunction with Judo, and we have a number of Judo representatives with us here today, both in person and online. To give you a brief rundown of the agenda today, we'll kick off proceedings with our keynote speaker, Warren Hogan, who's Judo's economics advisor. I'll let Anil in from Judo to give Warren a more fulsome introduction, which will be shortly. But I think we're in for a treat. Warren's one of the country's foremost economic commentators, and anyone who reads his contributions to the Fin Review on a Monday will know he's not likely to suffer from splinters from sitting on the fence. We'll then hear from Mark Napper, who will give us a deep dive into emerging trends in the agri space. Then you'll get to hear from me. We'll round out proceedings with a panel discussion where you can hit up our presenters with any questions you might have. So I'd now like to call on the Partnerships Director, third party for Judo, Anil and Nandaplan, to formally introduce Warren. Thanks very much.
Morning, everyone, and Blair, thanks very much for having me and partnering up with Judo for this event. Ahil Nandapalan, Partnerships Director for New South Wales for Judo Bank. It's a pleasure to introduce Warren. Warren's an economist with extensive experience in the analysing and forecasting of markets for both business, government and investment managers. He's currently our Chief Economic Advisor and the Managing Director of EQ Economics. He's got a pretty distinguished background across industry, financial markets, and policy analysis, with over 20 years in banking and financial markets. He's held prestigious positions or notable positions, including being the Chief Economist of ANZ, the Chief Economist of Credit Suisse Australia, and the Principal Advisor for the Australian Treasury. To reiterate Blair's point, Warren definitely is not backwards and coming forwards with his thoughts and opinions. So looking forward to hear what he has to say regarding lending in the agribusiness environment as a whole. Thank you.
Oh, good morning, everyone. I'm most likely to sit on the fence at breakfast time. I'm still half asleep. No, just kidding. So I've only got 20 minutes, 25 minutes, which is actually a very short period of time for me to speak. So I'm going to whip through what I think are some of the key economic factors sitting in the backdrop for the agri space. And I'll round it out with just a bit of a quick summary of what's happening in the Aussie economy here, with a view to one of the key themes for all businesses, but agri no different, this interest rate story and the higher for longer issue around rates and cost of capital and so forth. So I'll get stuck straight into it, and I'll start on the world economy. There we go. So just in terms of the cycle, and the cycle matters the next year or two, this is Purchasing Managers Indices, probably sort of the best real-time indicator of the momentum of global economies. So China, USA, Europe, going back about 8 years, you can see that they're slowing. Europe's slowing quite severely, which is no surprise. They're dead serious about getting rid of inflation. They've increased interest rates to almost the level of our interest rate, even though their longer-term fundamentals are very different to ours. Our interest rates should be a lot higher than theirs. The Europeans know the destructive capacity of inflation, both economic and social. They have very little tolerance for it. But the thing I want to note here is there is the softest of slowdowns occurring, both last year when there was a lot of concern and this year. These indicators need to fall down well into the low 40s to signal recession. So the summary on the cycle for the world economy is, unlike the discussion at many times in the past year, we're not necessarily headed for some recession. If we do have a recession, it will be technical in nature. It'll be mild and short-lived. The real risk in the next 2 years, and it's the risk that sits here, is that the economies don't slow. And if they don't slow, with this inflation sitting there in the background, That's your 1970s scenario. And that's when rates really have to go up, because we know the Federal Reserve in the United States is happy to sit around 5.5% for the time being. We know these other central banks, which got their interest rates between 5 and 5.5, whether it be the UK, Canada, New Zealand, the Europeans, are all now going to be patient. So hopefully we do see this slowdown, this soft landing. And of course, at certain times it'll look quite scary, but the reality is it's no evidence coming out of the real economy that we're going to tumble into a deep, dark recession. The risk that's come up in the last month is obviously in the Middle East. There's the oil price. That chart's now out of date. The oil price has collapsed in the last 2 trading sessions. I think it might have even touched $79 a barrel for Brent overnight. It's actually moved in the opposite direction to where the risk was. This was always going to be a key indicator for global financial markets and economists and policymakers about what's happening in Israel and the Gaza, and whether or not this situation broadens. Well, oil is behaving differently. In fact, the oil price peaked in late September, and it's been coming down ever since. So for the time being, and I'll come back to geopolitics in a second, that risk doesn't seem to be playing out. And of course, the risk with oil is not that it goes back up to $95 a barrel or 100. It's that it goes to 120 or even higher. And that just doesn't look like it's happening right now. Partly because demand is softening, I presume, with the slowdown in the global economy, and partly because we're not seeing this actual threat to supply. We have to keep an eye on that. I just want to mention China. This is Chinese GDP growth. Then we've got some projections here. Currently, 4.5–5% is the consensus. Not just for this year, but next and ongoing. I think that is the wrong view. I think China is well past its peak in terms of growth. It's got tremendous challenges. You can see the way that they're coming back into the fold with us. Maybe there actually is a new China that is going to go back to what they're doing pre-Xi, and that is engaging constructively in the global economy to raise their next level of development. I won't go into that in detail, but the current trajectory is their growth will continue to wind down. But even so, you can see over here, this is the additional economic activity to the world economy based on consensus view, so the blue line in the left. Even so, China is still a significant contributor, the biggest by a long way. We've got obviously places like India coming through strong. The United States is still highly relevant. The point I'm getting at here is that there is still going to be growth. And for China, even if we go on the softer growth trajectory, and China's not going to go away, there's no crisis in China. That's part of the benefit of having a command and centralized government, is that it's still a massive market. And if indeed they are going to give us more access, then of course we're going to see new opportunities arrive in things like food and beverage and other forms of manufacturing and services. So I see this as still a constructive backdrop. I'm just going to use this case study that I've used before from ABARES, or the Department of Agriculture, to highlight another point, particularly in relation to Southeast Asia. This is beef consumption, a study ABARES did. The growth in demand for beef here out of Vietnam and Indonesia. So that's the growth. What's been determined by income versus what's been determined by population. I just want to leave you with the key point. I don't have time to explain it, is that the population mass is sitting there in Southeast Asia and India. What's going to trigger a much higher demand for food and a higher quality of food is their wealth or their income. And they're all sitting right on this level of significant increase in demand, and it's already happening to some extent. So these countries, they've got through COVID. They've taken a bit of a hit like we all have. They've also having to deal with these tighter financial conditions. But again, the medium term, the 3, 4, 5-year outlook is still very positive. So a positive backdrop sitting there in our region. The center of the world's economy is moving closer to us. 30 years ago, it was somewhere around Europe. It moved towards North Asia, the North Asian development, and then China. And now it's heading down towards South Asia and India. And it's just getting closer and closer to us every year. That long-term fundamental for this economy has not changed. Our population, I'll quickly breeze through this. This is immigration numbers from the Intergenerational Report released a month or so ago. Now you can see the spike that's happening right now. Lots of controversy around that. I'm happy to talk about that in Q&A and the issues it's creating now. The longer term projection, because it's so politically difficult, is 235 a year, which is basically what Morrison and Dutton had in, because that's the average broadly of pre-pandemic decade. That's not going to be the number in my view. It is one of our greatest economic assets, is our capacity to bring migrants in and to offset major challenges around not just aging population, but growing dependency. Again, don't have time to really explain that. But a point I want to make is that the intergenerational report is projecting us to go in 40 years' time to 40 odd million. If we maintain the population growth rate that we've had for the last, or the 10, 12 years ahead of the pandemic at 1.6%, the population will be 50 million. So we have got lots of population growth. The economic incentive for high rates of migration is going to be so much stronger in the next 20 years, in the next 5 years, than anything we've seen in the past. And I'm happy to talk about that further. So the fundamentals around the demand for food, the demand for agriculture are very, very strong. Geopolitics, this is a Cold War view of the world, Cold War Mark I from Russia or Soviet Union and the United States. And this is schemed out as those supporting Russia and the Ukraine, those supporting the Ukraine and those who are non-aligned. And what it really does in the light of events of the last month, just reinforces where the geopolitical lines are. And we all know this. It is Russia, it is China, and it is Iran. There's other states around the periphery of that. History shows that this situation can come to a head at any moment, which we all hope it doesn't. I mean, the US was very quick to send a second carrier group into the Mediterranean a couple of weeks ago. That's a very unusual thing for them to do because they don't want to see this escalate. The other thing history shows is that these situations can last for decades. Standoff. China's big strategic issue is they are resource dependent. That is, they don't have everything within their borders. One of the reasons Russia continues to be a pain in the backside to this day is that they're resource independent. One of the reasons America will not go away is that they're resource independent. Obviously, someone like Australia, we're incredibly resource independent. The point of the matter is this situation is volatile, unpredictable. And that's something we have to continue to keep an eye on, and it will have implications. I'm assuming part of the motivation for the Ukraine operation was the food supply for Russia, but I'm not an expert on these things. So that's a negative for the backdrop. So moving to the Australian dollar, our connection into the world, which has been highly favourable for Australian agricultural players, miners, everything, because our currency's been so much lower than you would typically associate with the high commodity prices of the last 3 or 4 years. That's the chart on the right. That's the trade weighted index versus a commodity price series from the RBA. And you can see the massive dislocation. The level of commodity prices in the last few years was not much different to what we saw 15 years ago when the Aussie dollar was trading at parity with the US dollar and above. I think it got to 110. Excuse me. Why is this happening? Well, the other side of the equation is the interest rate differential, which actually just closed a little bit this week with the RBA rate hike, but it's still significant at minus 1.15%. It's only, well, it was at 1.4%, at the start of the week, is one of the largest ever in hundreds of years. Australia's interest rates, when all is said and done, when they're in equilibrium, as an economist would say, will be higher than those in the US or the UK or Europe, probably Canada and New Zealand as well, yet we're miles below, which is obviously one of the issues the RBA is facing. But if the interest rate differential was the only thing determining the Aussie dollar, then it would be trading at, what, 50 cents, 55 cents? So the point I'm getting at is, quite unusually in this last few years, the Aussie dollar is stuck between the two main forces that drive it, moving in the opposite direction. And for most of the last 30 years since the float, this data only goes back to 95, but those two variables have tended to move in unison. That is, when commodity prices are high, our economy is doing well, and our interest rates are higher than the rest of the world, and vice versa. And it's worked very well. This has been a very unusual set of circumstances. I can't tell you what the next step is. Sitting back in the big picture, purchasing power parity valuations, and all this inflation we're getting, and we've got more inflation than other countries now. It's not coming down as quick. By design, you could argue, is that the Aussie dollar actually probably is around the right level, long-term fundamentals, and isn't going up anytime soon. I actually think that's not bad news. The bad news is if commodity prices collapse, the Aussie interest rate differential is so negative and the currency falls 15% in 6-month period. That's inflationary. The RBA will have to jack up rates. That's something we've got to watch. But big picture, next 2 or 3 years, I think the Aussie dollar hangs around here, maybe a touch softer. I'm indifferent. There's no strong view of where it should go. So sorry, don't have much of a lead on that for you. But that's sort of the backdrop to it. Okay, moving here in Australia, obviously what I focus on, the Australian economy. The core view for the next couple of years is what I call a rough landing. It is the RBA's narrow path. This is GDP, annual growth, the way to think about the business cycle in Australia. And you can see the projection there. We're going to see a slowdown by hook or by crook. There's no way out of this. There is no choice. The inflation won't just magically disappear. We're actually pushing the bounds of historical reality. That is, whether or not we can actually pull this off without a recession is in itself going to be a potential miracle. But we're going to give it a go, and it could happen. That's a soft landing for most of the economy, a soft patch. The rough part of the outlook is that because interest rates have been so low for so long and then have suddenly moved so quickly, you're going to have some households that are highly vulnerable to this. We're probably already seeing this. And of course, we have a lot of businesses that won't survive, and we're already seeing insolvencies pick up. And I'm sure Blair will talk about that more. This will intensify, but the core of the economy, the great bulk of businesses and the great bulk of households will see this as nothing more than a soft patch, and we will get through a recovery. Inflation will get down eventually. They are quite slow. They're deliberately doing this. Government's obviously okay with that. And hopefully the bulk of the fall in inflation will be done by early next year. i.e. we get inflation down to about 3.5% early next year. And, you know, we grind out that final little bit of decline under 3% by 2025. Okay, what's the risk? It's a prominent risk, and it's exactly what I said for the global economy. It's a hard landing. It's a proper recession. It's more disruptive than the other scenario. And how do we get there? The economy's stronger in the short term. And we're already seeing hints of it. Economic resilience, the fact that people are still spending, there's jobs being created, and the inflation is stickier. That is, it's not falling quickly enough. The domestic cost base is starting to pick up in the last 6 to 9 months, particularly since the start of the financial year. And of course, the hard landing scenario is that the RBA is forced, dragged, kicking and screaming, as I'm sure you all agree is the way they'll go about it, because they're showing very little desire to get ahead of this, into a cash rate of around 5.5–6%. And I think at that stage, I'm happy to say that this economy will have a pretty sharp downturn. Even with that slump, the core view, the rough landing, is the consumer is going to be where most of the weakness is. I'm actually on a soft, rough landing type view. I think businesses will still be doing pretty well. There'll be a lot of business insolvencies, but most businesses will continue to spend and tick over. On this view, you get more damage done into the business community, higher failures, and it's unnecessary. And this is the thing, the narrative in this country around interest rates has been the worst I've seen in my career in almost 30 years. Any rate hike since the second half of last year could topple the economy over, completely underestimating the resilience of the overall economy for fear of the marginal player. And that's what's going to get us into trouble. You know, Jim Chalmers gets back from Washington in October last year, over 12 months ago. The US is going into recession. It's all, you know, horrendous. All of this pressuring of the RBA not to hike. If Glenn Stevens or Ian Macfarlane had been governor, they would have ignored it. But Phil Lowe, after the stuff-ups of the pandemic with the bad guidance, and probably because he's a nice bloke, couldn't, and the board couldn't. So that's how that scenario plays out. And that's a cash rate of 5.5–6. And of course, they're cash rate levels that we're seeing overseas right now. So it's very likely. Sorry, it's not very likely. It's a prominent risk. Okay, so what's happening in the slowdown? Well, we can see consumer sentiments in the pits, but they're spending. They've slowed the spending. But the level of retail sales, that's the dollar value each month, even when adjusted for inflation, is extraordinarily high. That is going to weaken a lot. We have got the worst ahead of us on both views. the soft landing view and the hard landing view. You haven't seen the worst of the consumer pullback yet. There has been belt tightening, but there has not been any meaningful hit to the employment markets. And of course, there's no fear. That consumer sentiment, which now is the worst episode since the early 90s recession when the economy crashed, unemployment surged, but that's driven by inflation, cost of living pressures. That's what's doing the damage out there in our community. That's what's doing the damage to the government politically. Why they're so tolerant of inflation and why they're allowing the RBA to take so much time, I think is a massive political misjudgment on their part. But, you know, they've got crappy economic advisors, I'm sure, and the Treasury doesn't know what they're doing. Anyway, there you go. I'm up and awake. Anyway, but this is where the pressure in the economy is going to be most acutely felt, not across all consumers, although it is widespread belt tightening. But when this gets worse in the next 6 months, it'll be certain subsets, and they're going to be the most vulnerable in our community, which is really unfortunate. Okay, turning to the food space, I've taken food retailing and hospitality, restaurants, etc., out of the retail sales numbers. This is inflation adjusted. So just to give you an idea of how people are spending on food. So it's dollar value each quarter, going back to 2015. You see the volatility of the pandemic, and you can see that spending in supermarkets and butchers and bakers is only now about 2.4% higher than it was in December 19, which is not much. We've had at least that much population growth. But you can see over there in the hospitality land, it's significantly higher. So there's been a big shift in spending patterns, and it's stuck. But the reality is that, you know, when you put inflation in here, the actual dollars spent, they're miles up, as you can see from the previous chart, but just in terms of volume. So the point of the matter is, particularly in the core non-discretionary parts of the economy, and obviously food is one of them, there is still strong, solid demand driven by population growth and driven by the fact that overall balance sheets are still in pretty good order, particularly with house prices going up. And of course, from a discretionary point of view, the question has to be asked, actually, how discretionary is eating out in this day and age, whether it's Uber Eats or going to your local. So that's just a few things to think about. I'm going to move to the farm sector now. I told you I'd jump around. This is from the national accounts. So it's the aggregate view of agriculture. Gross production in blue here. So you can see the surge in activity in the last few years and the pullback of the last year. And then this is net income, accounting for costs as estimated by the ABS. And then what I've calculated is a measure of profitability, which is the ratio of these two. That goes back all the way to 1959. So this is an aggregate old agricultural sector profitability measure. And of course, it surged last year, but it's come crashing back down to where it was a few years ago. But that's still pretty high compared to the experience of the last 20 odd years. I can't give you any insight. I'm sure Mark might, or someone else. People in this room know more about this than me, why we've had such a big long-term swing in profitability in the agricultural sector. It's always been reasonably profitable, but there is that distinctive cycle there. I just want to talk about the costs. This is the ABS estimate of intermediate costs, which are raw material inputs, fertilizers, all this sort of thing, versus fixed costs, wages, depreciations, rents, this sort of thing. And the point I would note here is that, yes, revenues have pushed up, and they really pushed up into 2022, but these cost pressures are not coming back. They're staying. In fact, they're still rising. That's annual growth for those two. They're still rising at solid rates despite the pullback in income, and hence the big profitability squeeze. And I think this is a major issue for the industry, depending on the outlook for prices and volumes and revenues, that the cost pressures are not abating and that they're quite high. And of course, these domestic costs, which all businesses in Australia are experiencing, have really ticked up in the last year or 18 months. And that's what inflation is it's the core cost base of the economy going up that everyone has to deal with, every business, every consumer. And of course, that's what is so insipid about it, is it gets in there and it just starts feeding on itself. And unfortunately, they've stuffed up. It's there. It might not be fully entrenched in consumer expectations, but it's entrenched in this economy. It was happening 18 months ago. It's happening even stronger today. And that's why they've missed their opportunity to jump on it. You know, there's many central banks around the world that were more than willing to deal a recession, a short-lived, easily overcome recession, nothing like what we saw in this country in the early 90s to get rid of the inflation. And even those central banks which were aggressive and willing to do that, they haven't been able to do it because the economy is resilient and we're miles behind them. That's a real risk we've got, but this is highlighting it in the agricultural sector. Okay, look, just a few things to rack up and then talk about interest rates. There's house prices, monthly growth. Sure, monetary policy is really tight when house prices are going up at over a 10% annualized pace nationwide. They're simply not. We reversed all of the falls of last year. House prices are going back to their highs. On my estimation versus core macroeconomic fundamentals, i.e. household income, we're going back to 27% overvalued nationwide, highest only bettered in 2021 at 31%. Okay, so we're like a skateboarder with the death wobbles on this one. Now, the reason I think we've seen a willingness for investors in particular to get involved in the last 6 months is the ultimate FOMO, and that is this concern about undersupply. So you can see there the amount of completions we do every year versus population. And yes, we have a surge in population that the industry wasn't ready for, and we're going to need another East Coast apartment building boom, and it will take time. In the surge in population 07, the units across the Eastern Seaboard weren't built until 2014. But what we're seeing now is people completely anticipating it and factoring into the price right now. You know, it took years for that to show up as higher prices. So there is definitely a speculative element to what's going in the property market right now, and it's not sustainable and it is not good for our economy or our community. The other point, labour demand, job vacancies, ignore that at your peril. I told the governor he needed to carry this chart around in his pocket every day. He surely didn't. This goes back to 1979. I've been watching it since I joined the market in 1994. I've seen Asia crisis, tech wrecks, Y2K, biggest mining boom this country's ever seen, and now this. The excess demand for labour in this country is through the roof. It's evident all around the world. It's severe here, and that's why that's a core part of the resilience of the economy, that there are other jobs out there. I mean, the Defence Forces are 5,000 people short right now across all parts of defence. Health, aged care, there's just shortages everywhere. If people need a job and they lose their job, they can get one. They just got to, obviously, whether you want to work somewhere, et cetera, but the point is, this is a major imbalance in the economy. Wages have been incredibly contained. They're up just under 4%. That's because of our heavily regulated system. That is 2- and 3-year EBAs. It's actually hurt workers because they can't get the flexibility. Their real wages have gone backwards. And of course, when real wages are going down, businesses will add labour to the capital stock to produce because they make money out of it. So you can see that the Fair Work Commission decision for the awards at 5.75% as a signal, you know, wage pressures are bubbling away. And of course, labour costs are going up, wage and non-wage, and that's coming through from all the businesses I speak to. So look, the RBA is trying to address it. And you can see these two critical features, which I think they should have gone 50 basis points this week. But of course, they're not going to do that. They're trying everything they can not to hike rates. This is the monthly CPI, and I've got the quarterly change in non-tradables, the green line. That's the ABS way of measuring domestic inflation, and it's picking up again. Then over on the right is the quarterly change in what's called the producer price index. And that came out 2 days after the CPI, about a week and a half ago. In fact, 2 weeks yet tomorrow. And in the quarter, Q3, it was up 1.8%. It'd been rising 0.5, 0.6, 0.7 over the previous few quarters. Its high in June 22 was 1.9. That's that domestic cost base picking up in Q3. So look, this is war on inflation's far from won. This is the main view, like my central case, which is one more rate hike. The market's pricing a small chance of one more rate hike. The market's constantly been behind this. They rarely get ahead of it and price in more. It's a variety of reasons for that. Most bank economists are not being aggressive. I mean, they've all sort of been quite behind this. That's been part of the broader narrative, which I've said I think is one of the worst I've seen. Look, I still think there is a chance that this belt tightening that we've seen from consumers is going to morph into a generalized pullback by business in terms of hiring and investment plans. We're starting to see evidence in our business survey, the Judo Bank PMI, that Standard & Poor's put together, that we sponsor, that businesses are finding it harder to pass through those higher cost pressures to final prices in the last 3 to 6 months. That, of course, hits profits, and the main driver of business behavior is profits. So the profits are starting to ease back. You're seeing that in the earnings season. We're hearing that on the ground. They're still very healthy, very solid levels. So look, we could still see the RBA right on this and avoid that disastrous situation where we have to just jack rates up. It's exactly what happened in the late 80s. They just underestimated it and they just had to keep going until, as Paul Keating said, we could hear the economy snap. That's the scenario I've been begging them to try and avoid for the last 12 months. You can ask any of my Judo Bank colleagues. It's exactly what I've been saying. They've taken the opposite strategy. They've been softly. I hope they're right for all of our sakes. I doubt they'll get away without at least one more, probably in February. Let's wait and see. None of us know. The key now, though, is business pulling back. The businesses can't pass on that cost base, and that therefore creates a pullback in investment plans, pullback in hiring, bit of fear out in the economy, softer consumer, and then we get that inflation starting to go down. Okay, to wrap it up, I've surely spoken more than I should. The 3 scenarios for the RBA cash rate, the core scenario, one more in February. I doubt they'll go in December. There's virtually no suggestion in the statement this week that they're ready to jump on this again in December. Something pretty crazy would have to happen between now and then. The risk scenario, which I've talked a lot about, is a cash rate at between 5.5 and 6. That's what we want to avoid. We all end up in the same spot eventually. The final point I want to leave you with is the chart on your right, and that is the higher for longer. You can ask, again, the Judo Bank team. I've been showing this chart for 2 years. We've gone through a long-term turning point related to demographics and a few other things. Rates are now drifting higher, not massively higher, but yeah, we may get some cuts in a year or so's time. They might even be substantial, but then the next cycle, the cash rate will probably go even higher. So you need to factor that in your thinking, that interest rates are now higher for longer. That was exactly the message that came out of the US bond market in the last 3 months, where even as the Fed looks like they're finishing their tightening, the 10-year bond kept pushing up to a higher level. So that's important to factor in. All right, I'll leave it at that and take any questions on the panel. Thank you. Thanks.
Hey, our next speaker is Mark Napper. Mark's had a varied career in public practice and in-house roles. He's had a number of senior roles in a number of agribusinesses, and has also held board roles in various industry associations. Since 2012, Mark has run his own business advisory firm with a focus on horticulture and manufacturing. Mark's also got his hands dirty running until recently his own stone fruit and orchard or custard apple orchard in the Northern Rivers. So welcome, Mark.
Well, thanks everyone. The trouble with all these things when you talk about agriculture is that it's such a broad topic, and there's so much that you can talk about, and that I've only got a short time. I run the risk of probably having too many slides, so I'll have this on a death by PowerPoint presentation. But I just want to give you an oversight of what, of what is happening in Australian agriculture, following on from what Warren was saying previously. Give us some insights into the major industry sectors, and then give a wrap up of where I think it's sort of heading. The trouble with talking about agriculture too, it's a bit like talking about, the ASX 500. Someone's talking about, it's really charting really well and everything's going fine. And there's always either myself or someone else in the audience says, well, how come my shares have just tanked? So when we talk about the agriculture, I'm looking at lot of the ABARES figures, and they're high level, like super high, because it's very hard in agriculture to get accurate figures. Farmers are a bit cautious about telling the taxman anything. So it's very hard to get accurate figures and timely figures, I should say, more to the point. So I'm running on the top, I should say, on the ABARES figures, giving inside the latest ones, and then where I think it's going. But just an overview for the 23-24 sort of financial year. The value of agriculture production is forecast to fall by 14%. And that's a lot to do. The current thing at the moment is the drought, which we're experiencing in Sydney, but throughout the eastern seaboard, particularly in northern New South Wales and up into Queensland. It's a long dry period there. But also global prices, commodities are also reflected the forecast to fall, and that's because mainly the overseas supply is coming back into a more of a normal situation, whereas the last few years we've had droughts in a lot of the major grain producing areas, and that lifted global prices. And of course, we just had normal supply chain issues, not normal, the supply chain issues caused by COVID. We'll also see lower domestic production falling, and prices down the export going to drop by 17%, mainly based on volumes. And the big thing is, one alluded to, particularly in Broadacre, we're talking about here, farm incomes, cash income will fall by 41%. But having saying all that, sort of a bit like doom and gloom, but it's fallen back from record highs. And even so, even though it's dropping back, we're still going to be the production, the way it's tracking at the moment. Of course, it all depends on the weather largely. It'll still be one of the third highest on record. As I was saying before, global prices will ease, and all the forecasts are going to be impacted largely on the weather at the moment. But even last night, we're seeing some rain falling through northwestern New South Wales in much welcomed areas. So it's sort of, as usual in agriculture, it's a watch this space. Just to give an idea, and one's graph's probably better than this one, but that gives you an idea of the fall in the farm incomes. They're going to go to around 197,000 per farm, but it's also one alluded to, the costs are also increasing, and we're seeing this within our own family budgets. You might have got a big wage increase, but the costs are going up. And farms, it's not much different to that at all. But again, I just want to stress, they're falling back from a high level. How far they'll fall, again, is a question. Just generally looking at, then we'll drop down to the individual levels. Crops, production is saying it's down about 19%. Most of it's happening in wheat. Then we've got canola and barley also down. But in those sorghums, cotton, they'll probably, they're down marginally or lower than where they, not as severe as in the wheat. I think mainly in cotton. Probably, I guess, the beauty is having the floods, a lot of the water storages are full. So it's the farmer's dream, actually, to have no rain and heaps of water. That's if you're an irrigator with plenty of storage. If you're a dry land farmer, then you've got a huge problem, of course. Getting into my little love area is horticulture, or love-hate, I suppose, depends what it is. Depends what day it is and when you ask me. But horticulture, ABARES forecast it to go up by $1 billion. I've got doubts on that. I believe that in horticulture, the major crop, particularly in nuts, we've had a large drop in prices, particularly in macadamias. They were going from $6 a kilo down to $1.50 to $2. We're seeing some sort of increase in the macadamias, but also almonds was also in the major hit in prices. So nuts generally were down. So I've got a doubt on whether horticulture is going to see that increase in $1 billion, unless some of the large for apples or citrus, but I can't see it going up. Sugar is going up. Of course, again, there's supply shortages with sugar. So we're seeing a lift in prices. So all my friends up on the far north coast in New South Wales who bought a sugar farm cheap, planted macadamias, I think that was a great thing. And now going, oh, whoops, hang on, wait a minute. But that's agriculture. But wine grapes got marginally $100 million to bring in. It's not a huge change there. Then we talk about livestock. I've gotten used now, instead of showing cattle, I've actually shown meat products because I do a little stuff with young people in schools and they don't know, show a cattle, they don't know what they're actually talking about, you know. And we so show a chop or a steak or something. Oh, right, that's what we're talking about. But I'm hoping you're more informed on that. So the value of livestock production is saying it's going down, and the lower prices outweigh that higher production figures as well. The turn-off rates, and I'll show you some reasons why that is. But those of you who are involved and got contacts in that industry or in regional areas will see and would have heard on the news too, we're talking about it, the prices have dropped hugely. But guess what? They haven't dropped in Coles or Woolies. But the prices have dropped there. Veal production is down too, and we're seeing sheep meat, milk also down as well. So it's the same across the board. We're seeing a downturn in production. Export values then are expected to fall, volume-based, but also price-based, as I mentioned before, because of the overseas supply, generally across most of the quantities we trade in Australia, those supply chains have come up. Except in livestock, the Americans are still, they've got their smallest herd numbers still in the States. So there's still huge opportunities there for us. But generally, there's an increased global supply. We're talking about in agriculture generally. But as I said before, it's still going to be, in export terms, around about the third highest. The important things to look at, as Warren was touching on, rising consumption patterns in Asia, and especially in China. China's coming back into the meat, but it's not as strong as the industry was hoping. But trusting after Albo was there, he sorted everything out, and we'll see that start to lift. And as one was alluded to, you know, the low Australian dollar, that's going to certainly help exporters, at least in the short term. When we talk about crops, wheat is going to, prices may remain high, and they've got a slight fall in global production in Australia, fall in global production in Australia too. We're a major player, obviously. But interestingly enough, Russia and Ukraine have got a high production this year, even despite the wars going on. But the big trouble is, how can they get it out? And we see in the news, you know, with the supply getting out of the Black Sea. Coarse grains and oilseeds, there we got forecast record corn and soybean crops in the USA, Brazil and Argentina. That's impacting the prices. And I mentioned before, China is starting to move the tariffs on barley. Rice is also benefiting from India's ban on basmati rice exports. And sugar, we mentioned that before, is high because of Thailand and India. I've mentioned the livestock. Then domestic. That's how often domestic, global prices will affect domestic, but not always. But certainly the dry conditions currently, that's what's really driving increased prices, the price positive outlook. The prices are still trading above that 5-year average, but we've just got to look at what's happened mainly in Canada and Argentina there to get an idea of prices globally affecting us. But even in the world, global price, stock levels, they're still 13% below. And that's again because of the droughts that we've had before. And here's just a bit of a graph here on the domestic market for beef. Here we got the restock of the steer prices, and you can see there from September last year, the highs around 600 down to now the 250s, the high 200s. That was in just the other week. So we've seen a huge drop in the prices. And that's because, as Fiona Simpson said, I think probably, she said, oh, well, we've really done, in the agriculture industry, we've really done a great job in educating our farmers how to be drought tolerant. And that is to sell their stock quickly as soon as they hear of a drought. And that's what's happening. Everyone's shifting their stock rather than holding on and going through what they went through only 6 years ago. are having to pay huge feed prices. So we're seeing a lot of shifting in the steers and in sheep market too. This one is interesting just to get a better picture of the difference in those prices. You've got the current month there on the first column, and you compare that to the second last column, the fall in the year-on-year average from last year, and even the percentage there, the actual figures in a year ago, 533 to 147 in Victoria, and still well below the 2-year average. So why is that sort of happening? Talking about the drought, and I'm just going to show a quick couple of slides here. That was what DPI put out for New South Wales. That's 12 months to the end of September. So just visually, all you who are picture people, just notice that green. Green's sort of okay, non-drought areas. The red's the intense drought, and the ochre sort of colour is drought, and the other lighter ones are drought affected. All right, so then this is one, and I had to sort of do a dodgy copy of this because I couldn't download it properly. But you can see this is just from the other day, like about the 2nd of November. And you can see how that green has contracted quite substantially. And we're seeing larger areas of more intense drought and the drought affecting areas. But of course, if you're a farmer, I was saying before, we're talking about prices and down and drought. But if you're a farmer in the southwest, New South Wales, it's not too bad. But in the northwest, New South Wales is where we've got the issues. Similarly with Queensland, you can see there in that southeast Queensland corner, and that's some of the major producing areas, particularly in horticulture. I was up at Bundaberg a couple of weeks ago, and it's as dry as a chip up there when you're driving around. I can't remember the exact figures now, but they've had like 10 or 20% of their annual rainfall as of in September. So those areas in southeast Queensland is really bad. They're desperate need of rain. So I couldn't get maps for the other states, but you see there with the BOM declared August to be the 10th driest since records began. That's affecting Queensland, New South Wales, Victoria, and South Australia. Western Australia, they got dry conditions, but then there's the exceptions, and this is a strange thing where we've got Esperance, which has received average rainfall, but most of the grain-producing belt in West Australia has been badly affected. Just quickly on input cost pressures. So yes, as Warren was saying, farming is not immune, just like every other business. The cost pressures going up. Every business that I'm involved in, we've got the same pressures, the cost pressures, particularly labour. But even in the non-farming sector, put your prices up. Even now we're seeing that, as one alluded to, that there's a ceiling on that. Unfortunately, in farming, in most commodities, you're actually a price taker. But some of the things we're seeing here, there has been a stabilising of fertiliser prices. Some of the fertiliser prices in the previous years were up 67%, huge increases. They're coming back a bit, and they're forecasting, particularly in the fertiliser and agrochemicals, we'll see an easing there in the prices, which is welcome. But diesel prices will remain high or at their current levels. And the big one is the wage increases and supply shortages, particularly for labour-intensive industries such as horticulture, particularly in the vegetable industry. There's a lot of veggie farmers who are really struggling at the moment and just being able to get the crop off. At least in tree crops, it's not quite as bad, but it's still a really bad thing to be able to get the labour, and then also the wage rates have gone up substantially. Horticulture, there's been a lot of talk about underpaying workers, and the unions ran a strong campaign for a number of years, bagging out horticultural growers. Of course, they pick a few growers that were doing the wrong thing, or labour hire companies that were doing the wrong thing. Now we've seen changes to the award, which make it really hard when you're in particularly horticulture, when you've got harvest and you've got to do an intensive period. If you're going to pay super overtime rates, that is a killer. Whereas before we're able to average things, and it was a lot more manageable, should we say. So wage increases and supply shortages. Even at Byron, we were always used to laugh because we had backpackers coming out our ears, and my mates in Western New South Wales used to complain about wages, labour supply, and I used to just laugh at them, going, ha ha. But of course, COVID changed all that too. There wasn't a backpacker within Byron, which was quite nice in one sense. But in terms of a farmer, then you couldn't get the labour. So those labour shortages are through. Energy prices, like every business, are still a key concern, as is the interest rates. So we see here where debt service levels of farm were 3% in 22 and now 8%. And from what Warren's saying, probably going to go further. So lower Australian dollar is sort of benefit in terms of you're an exporter, but the flip side is your input costs also are increasing. Other good point is, but the shipping freight rates seem to be going back to their pre-pandemic rates. Just some of the other headwinds. Water is the big issue, apart from a drought or anything anyway. Water availability is a huge issue. A lot of people, the big farmers, have spent big, particularly almond growers and the farms up around the Bundaberg area based on water access. And in Queensland, they've had trouble with one of the dams where they have to lower it. That's caused problems. And currently we've got the federal government now talking about a buyback. So that's of a huge concern to the industry. As I said before, the labour availability and affordability is a key one. Biosecurity is the other sleeping dog, which raises its head every now and then. You may have heard about the varroa mite. That's the recent one that we've had. Australia was one of the few countries in the world that was free of it. Well, we're not anymore. We've got varroa mite, so we've moved from the eradication stage into now just managing it. And so that's a whole new way of doing things which the industry has to adjust to. Big danger also is fire ants. That's in Queensland and sort of moving south. I don't know whether they'll be able to bring that under control as well. But the other thing is for the industry is the lumpy skin disease, which is a cattle disease. Foot and mouth disease is the other one they're always worried about. And for horticulture, it's the big worry, or the big black swan, if you like, is citrus canker. The other issue for the industry is increasing productivity while still minimising the environmental impact. And there's a lot of great work being done on farms, where the Greens tend to, paint farmers as, the rapers and pillagers of the environment. There's a huge amount of work the farmers are doing to protect the environment because they are land carers. They have to look after the land to get their productivity, but getting that balance right is a key thing. And that leads into the social license. I think farmers have to do more to maintain that social license. As the city becomes more disconnected from farms. In my day, you always knew someone who was a farmer. That's less and less now. We have to become better at educating the community as all the good things that the farmers do, and the whole issue of food security is a major point there. So just in summary, there's a difficult time ahead for most agriculture sectors. We've got weather, prices, labour and economy. But having said that, farmers are one of the most experienced risk managers. Will be people who will drop off, and that happens in all economic downturns. But generally, the farmers are really experienced risk managers, and I'd encourage you who are lending to them to work with them in that area. Financial, so you need to understand your sector. And there is, so I've done a high helicopter level. As you see, there's various regions, but it's different. You have to know your region and your clients, because there's huge variations in all of them. And I'm happy to talk to you about that after. But agriculture is and will continue to be a significant Australian industry. I believe it's an industry worthy of support by a well-informed community, which is on the basis of agriculture needs to do that, to educate the community and also you guys as to really what's happening within the financial sector. But happy to take questions during the panel. Thank you.
Thanks for that, Mark.
Okay, to conclude the formal presentations, I'll be focusing on the insolvency market generally and with a bit of an agribusiness flavour. Key things I'll be discussing are updated insolvency statistics, the small business restructuring regime, business sector insolvencies, and farm debt mediation. So statistics up to October highlight an increase in insolvencies in last year and a continuing increase into this year. As you can see from the green line there, the trend did drop a bit in September. There are 8,154 insolvency appointments last year, compared to a total of 6,243 for the year before. That represents a 30% increase. And this year, thus far, there's been 9,006 insolvency appointments. So I think we can say that the level of insolvencies has returned to the pre-COVID level of the 2019 year. The rise of insolvencies can be attributed to a normalisation in the economy with the leaking out of the various COVID relief and support measures. The ATO took a benign approach to debt collection in the COVID and immediate post-COVID period. That has changed. The ATO has pivoted and increased its debt collection activities over the last 18 months, mainly through the use of its DPN regime to target companies with substantial tax debts. There have been supply chain issues and the rising inflation and resultant remedial interest rate rises. It will be anticipated that those interest rate rises will have an effect on insolvencies going into the new year. However, we do probably need to look at it a bit in terms of context. The pre-COVID period was a relatively stable trading period. The insolvency landscape was relatively benign. That graphic is insolvencies over the last 20 or so years. And it probably indicates that the level of insolvency last year was still under the level of the post-GFC issues of post-GFC years of 2012 to 2016, which were also characterised by a reduction in a number of commodity prices. So despite the number of news.com articles which reflect the skies falling, and admittedly the construction industry has hit a rough patch this year, the reality of much of what we've seen to date is a correction in the insolvency market to pre-COVID levels. That statistic is basically a breakdown of the various types of insolvencies, and so not surprisingly, the most creditors' voluntary winding up is by far the most predominant appointment method adopted. That's consistent with an historical trend which has prevailed for some time pre-COVID. As the year has progressed, there's been an increase in the use of VAs, which suggests perhaps there's been a few larger companies which have been subject to distress, and there may be opportunities for restructure by way of a deed of company arrangement or going concern. Perhaps the hidden story this year behind the headline construction industry collapses is the rise in the use of the small business restructuring regime, which is the green line on the graphic. The small business restructuring was introduced at the beginning of 2021. It was in response to provide small business with a permanent solution following the withdrawal of the temporary COVID relief measures, which were withdrawn at the end of 2020. Small business restructuring includes many of the elements of the VA regime, but attempts to carve out some of the costs of that process, which was seen as an impediment to small business successfully utilising that process. So to be eligible, you need need to have debts under $1 million. Tax lodgements have to be up to date, and all due and payable employee entitlements have to be paid up to date. One point of distinction with voluntary administration is that SBRs is a debtor in possession model. That is, directors remain in control and creditors are not provided with the protection of the personal liability of SBR, as in the case of voluntary administration. Initially, these provisions were not embraced in any significant fashion by the small business community. However, as seen by that graphic, this year there's already been a noticeable uptick in the take-up of SBRs. There's been 500 this year already, compared to 82 in the first 18 months of it being in place. Figures available do suggest that many small businesses are overwhelmingly using the process as a mechanism to restructure ATO debt. As noted by the other speakers, there are indications of a slowdown in the rural space, and as a relatively recent innovation, this may be an appropriate mechanism for consideration by suppliers to rural producers who may find themselves negatively impacted by such a slowdown. Obviously, the strict qualification criteria has to be considered.
That graphic's a fairly busy graphic, I'll acknowledge that. But what it's endeavouring to say or indicate is insolvencies by industry sector over the last 3 years from July 2020. And that basically indicates that agriculture, farming and fisheries contributed only 1% of all insolvencies. So there's been a total of 265 insolvencies since July 20 in that sector since July 2021, with 123 of these being in this year. Even allowing for some statistical error in that some agribusiness may have been classified in another industry, for instance, potentially transport, the figures do reflect the sector has been relatively insulated from distress compared to, say, the construction industry, which has been running at something like 25 to 28% of all insolvencies in the last 2 years. This period has been noted by high commodity prices, good seasons and strong demand. As has been noted today, a slowdown in the sector may be on the horizon. So, at the extreme end of distress, a number of jurisdictions have a farm debt mediation scheme in place, whether it be compulsory or voluntary. A system of farm debt mediation is not in place in Tasmania, ACT and the Northern Territory. Unlike most other industries, mediation is required before a creditor can take possession of a property or other enforcement action under a farm mortgage. It was introduced in acknowledgement to the variables that the rural sector is subject to, such as climatic conditions and seasonality, which often leads to variable cash flow, which is not as prevalent in other sectors. Obviously, there was obviously also a political aspect to its introduction, as farms are more often than not only a business, but they're also the family residence. In addition, certain financial institutions implement a voluntary moratorium on enforcement in drought-declared areas. In broad terms, to be eligible for mediation, the following elements must be present: a farming operation, and it must be secured by way of what the various, what all jurisdictions legislation describes as a farm mortgage. The New South Wales legislation and other jurisdictions are fairly consistent in this regard. Covers mortgages over farming land and water allocations and all vehicles and machinery used in connection with the farming operation, whether required for the purpose of farming or not. It doesn't cover stock mortgages, crop liens, or wool liens, or an interest of a lessor in any farm machinery that's leased. So upon default, a creditor must provide an eligible borrower the opportunity to mediate prior to proceeding to enforcement. Time allowed it varies across jurisdictions from 10 to 21 days. If the farmer avails themselves of the process, the credit provider is restrained from taking enforcement action until such time as the mediation takes place. If the farmer refuses to mediate or fails to respond within the relevant period, the creditor can apply for an exemption certificate, which remains valid for 3 years and then the creditor can proceed to enforcement. Failure to provide the opportunity for mediation will provide grounds for what's termed a prohibition certificate, which restrains a creditor from taking enforcement action and can restrain enforcement for 6 months, for up to 6 months, or until the mediation takes place. Both farmers, their advisors, and credit providers need to be conscious of their rights and their obligations under the legislation, as the consequences for not adhering to the requirements are quite severe. The Hay and Royal Commission in 2019 recommended that basically there be a national farm debt mediation scheme rather than the various state-based schemes. And whilst I understand there's been some movement in that direction, that's not been implemented at this stage. That probably brings us to a closure of our formal presentations today. So I might ask our other presenters up today and we'll proceed with the panel discussion. And I encourage everyone, and obviously it's panel discussion, it's not just a discussion amongst the panel, it's a discussion from you folks as well. So if any questions is in your mind, feel free to throw it out to our panelists, and I'm sure they'll be able to answer, or at least endeavour to answer them for you. So I guess as the chair, I'll start off and probably direct the initial question to Warren. So I suppose you did address this anyway to a degree, but what's your read on the current instability in the Middle East? How will it impact the world and Australian economies?
Look, if it stays where it is, like
an Israeli operation to flush out and eradicate hummus, then I think we can see from the way global markets are going that it's not going to have major implications. It's all about the escalation, and at this stage that seems to be contained. So look, it's really just a matter of watching. But if we see this played out how the Israelis want it, and that is that they flush Gaza, they go and try and set up some sort of a non-Hamas government, and that's obviously a very costly exercise for Israel, but for the rest of us, it'll,
And presumably the allies as well.
yeah, of course, there's be a lot of support coming from America and other places, but I don't see that as being a game changer. But if you started to see much more active engagement between Iranian and US forces and more US troops on the ground, and anything, I think that it remains the case that the thing you're watching is the oil price. That's the main channel. And of course, it's exactly what the world doesn't need. We're trying to slow down these economies to get rid of inflation, and a significant spike in oil is stagflationary. It's the opposite. It hurts growth, sure, but it adds to inflation. It'd just be a sort of a rerun of the 1970s, sort of in terms of the risks and the parameters around it. So look, we're not out of the woods, but so far so good in both terms of the oil price and also this thing not getting out of control or getting away from just being a Hamas Israel thing.
I guess, like in terms of, you probably also answered this in terms of your thing. I get the impression you're not totally in favour of how the Reserve Bank's gone about controlling inflation.
Yeah, look, I've been forecasting for 25 years, and it's all good in hindsight. But I've been very clear from the start that you underestimate where you're going to get yourself in trouble is underestimating the resilience of the economy, the persistence of inflation, and that's what they've done. I think they should have started this. I mean, you look at it, they've done 425 basis points, but let's go back to the start of this week when we're making the case for a rate hike. They've done 400 basis points, and 300 of those were last year. They've only done 100 basis points this year. So that impulse, that monetary tightening is going to soon fade from the economy. And what you're left with after that, what the RBA is, it's like the one thing they don't want to talk about is the real interest rate. In this country, we have not got our cash rate above core inflation. Every other central bank was tightening until that happened. The Fed did not pause. And they paused in June when they got their cash rate above 5 and inflation was at 5. That's a zero real interest rate. That was always got to be the first sort of policy target. And the RBA has ignored that. And I think, and the reason I worry about it is not because I've got a mortgage and I care about the economy, and it's not going to help Judo sticking rates up. But I don't want to see the rate go up to a point that it breaks the economy, as I said. And I think they've just been too softly on this, and they should have gone harder. The bottom line is that we have very few examples in our history or any other modern economy's history where you get rid of inflation without a real interest rate significantly north of 2%. And if they allow the inflation to build in some momentum into the system, then I think that's where they're heading themselves. They had an opportunity to stomp on it early and they didn't take it. And what even these other central banks that did, it's not clear that it's going to work for them either. So, yeah, I disagree with it, but I said I've been saying it from the start. I hope I'm wrong. Other policy tools, other things they can do apart from raise rates. Well, I just don't know. I mean, we are getting some signs that businesses are starting to get affected, that they're not able to pass on the cost pressures, and that'll hurt profitability, and they'll start to pull back. And if that happens, the economy may slow and we may get away with, this may be the peak. I don't know. I mean, I'm less willing to be bold about my forecast than I was at the start of this year. At the start of this year, I was looking at the economy. But
what scares me, what scares the life out of me as an economist is if they have to take that cash rate up towards 5.5, 6, I can tell you what will happen, and that will cause a lot of distress and hurt this economy big time. The problem they've had is they've had certain players, a lot of them political, telling them the economy is about to fall over. The bank economists haven't helped. You know, they've been constantly saying, oh, they're only going to go to 2.5, they're only going to go to 3, they're only going to... There's been this completely misdirected narrative. It's the worst I've ever seen in my career. No one wants to see rates go up, but where the narrative was wrong was that it's ultimately the level of interest rates that matters. It's calibrating the interest rate to the economic fundamentals. What we've seen in the last little while has been, as in just prior to the pandemic and through the pandemic, is just a one-off completely out of whack. So we're rapidly normalizing. We need to do more. Can I see it? Yes, I can, unfortunately. I can see them dragged kicking and screaming, and then I can see them having a what I used to call an undie changing moment, you know, when they suddenly realize, oh shit, and they have to hike every month for 3 months or 50 points, or I mean, that's why I said they should have gone 50 in February. I think they should have gone 50 now. You got to remember, if they've overcooked it, they can cut 100 points any day of the week they want. They can reverse it within a second. Maybe not a second, but a day. It's all about politics. It's all about presentation. They've shot their credibility to pieces. Thank God she raised this week, because that would have been the end of it. But so yeah, look, it hasn't been great, and I just hope we don't pay the price. I hope we start to see some real concerted signs of a slowdown, and we are seeing them. It's just got to be more, and it's got to last longer.
Oh, Andrew. Sorry, mate.
Okay. Warren, given the RBA's reluctance to step up, is there any levers that the world's greatest treasurer, Mr. Chalmers, could pull?
Yeah, there's probably about somewhere between 2,000 and 20,000 levers. I mean, monetary policy is an interest rate. For people complaining about rates going up, before they say we've got to stop raising rates, well, let's get rates back to their normal level, which is a 2% real cash rate, which right now is a 7% cash rate, which of course none of us want. So let's inflation get down. Let's say it's 4 or 5, normal. Okay, but then you're not going to get rate cuts. And then let's take that world, and then let's see what the government's going to do. Well, is it going to be agile enough? Is it going to have the political capacity? The reality is the government's got huge amounts of things it can do. Finally, they've cottoned on at the behest of the IMF that it's actually the state governments that are blowing the whole thing up with all their spending as well as infrastructure. The idea of cutting back on infrastructure projects is not only ridiculous, you can't do that quickly enough to meaningfully. I mean, unless you're going to literally blow a whistle and down tools on every building site across the nation. And of course, we need this infrastructure. I mean, most of the complaints in my career is we haven't built enough. So look, the bottom line is they missed an opportunity in the budget to cut back more. I actually said, and I said it to the Treasurer, you should have done twice as much cost of living relief for low income earners and cut back more. You should have sort of basically done a cost cutting exercise of 10% in the public service. I mean, all of us in the private sector have to go through it every whatever amount of years. But yeah, there's heaps of levers they can pull. So yeah, they can raise taxes. They can, you know, and the thing is, you can't raise taxes on the rich because it's not going to change anything. You got to raise taxes on everyone, and they're not going to do that. Not only, I don't advise them to do that. They should be cutting back on spending. So look, there's heaps they can do. They don't have the political appetite. The federal government does deserve some credit. They're not making things a lot worse. But you know, they're not doing a lot. But it's the state governments that are a real problem. But all of those ships have sailed. Our problem is now, and the problem with fiscal policy, unless they announce a tax hike or some sort of spending cut immediately, it's very slow to operate.
Would you have a question at some stage, Peter?
How real is a threat of stagflation in the future?
Yeah, I mean, I'm not that worried about it. I think the circumstances that led to the 1970s are different now. One of the biggest and most profound changes in the global economy, Western global economies or advanced economies, and ours is the rolling over of the baby boomers, which creates labour scarcity. And so we're now coming to learn that this labour scarcity is not just a COVID phenomenon. And that's why I say immigration is such an important asset we have, because we know how to do it. People want to come here, et cetera, et cetera. So yeah, I mean, I think labour scarcity is the big issue that we've got to deal with. Did that answer your question?
Just a question. I've got a couple of questions actually. First one's certainly for Mark, but follow-up question maybe for the panel wider as well. So, with some challenging times ahead for the agribusiness sector, Mark, what do you see as some of the typical characteristics of the players of the operations which are going to outperform the average? And then follow-up question might be linked to that. As we see some distress coming into the sector and some businesses and large farming operations coming up for sale, where do you see the money coming from or the investment coming from? Who are the players that might come in and make some acquisitions there?
Okay, yeah. Well, to do the last one first, we're still seeing a lot of interest from mainly in the Canadian super funds. So there's still big super funds that are looking at farms, and see that in horticulture as well. But that's broadacre. And I think that's generally because they take a longer term view. So they look at the fundamentals generally and say, okay, yeah, this is still a good play. Whereas we tend to, Australians too, and the financial sector within Australia just tends to look at short term. So that leads into answering your first question is those players that do have the long-term view. Yeah, I mentioned the macadamia growers before. There were some my colleagues who bought large farm and expanded their farms when it was $6 a kilo. They did their sums on $3 a kilo. I think this is nice and safe, and it's now like $2. But they're still positive because the underlying fundamentals for the macadamias is still strong. So it's not labour intensive, and it's a highly mechanised industry, and the nut market is strong, you know, generally globally as well as locally. So I think it's those players. The key, like a farm, is the same as any business. You've got to know your costs. A lot of farmers don't really know what their costs are. So those people who understand their costs and are prepared to invest in the farms too. But the problem I mentioned about the farm incomes coming down, or they're being really high, and you may think, oh, that's great, they've stocked up. But we've got to remember that they only just came out of a drought in 2019. After the drought, they then had COVID, floods, and fires. So ability to restore their financial stocks too is under stress. But yes, those players who know the markets, who know their costs and invest in their farms are going to the likes of Scott.
Right, yeah, we might get Neil and involved. Yeah. So I guess I'll bunch a couple of questions up together there, if you like, mate.
Sure.
So I guess are there enough financing options available in the agricultural space? And rightly or wrongly, the rural space has a reputation of being conservative. What do you think are the particular challenges of introducing a new finance product to the sector?
A couple of questions, and I did tie well together. First off, I'd say no, there's not enough funding options in the agribusiness sector. If you stretch it out to the broader economy, and especially in the metro areas and in commercial finance, one of the stark trends in the last 20 years has been a proliferation in the number of lenders supporting businesses. It's no longer just the big banks or the small banks. There's, the full tier of funders, from finance companies that specialize in certain industries to different parts of the value chain and trading cycle, all the way up to private equity and private lenders. Whereas the agribusiness, sector hasn't had that level of proliferation of lenders. It's very much the major banks, the regional banks, and then really clear air until you end up in private equity and private lending. So that's where, Judo has entered that space in the market, really overlapping with the major banks, getting up towards where that private lender is stepping in to support those businesses. So, and, we've seen it across the whole economy. And you guys will see with your clients, there are plenty of businesses out there that should be banked by the banks and regional banks, but aren't. And that's what we're looking to come in and support. That kind of rolls into that second question. And also, I'll put my hand up. I was the biggest cynic about lending to agribusinesses as Judo Bank. I thought, you're targeting businesses that have had generational relationships with banks. 200-year-old brands that have had positions in market, and Judo's coming in as a 6-year-old business or 7-year-old business, as last year trying to establish it. And I've got to say, I've ate a lot of humble pie on that and been very wrong. As soon as we planted the flag, it's been like drinking out of a fire hose. And I think as to why that has come about is really our proposition is very much like what banking was like 20, 30 years ago. Relationship based, bankers who are capable, understand invest time in getting to know their clients and are able to make common sense decision on the back of that in a market where the backdrop is cost out, industrialization of decision making and what have not, where people aren't necessarily able to be supported the way that they would have expected or like to in the past. So while there are challenges in that, at the moment the biggest challenge is actually getting bodies on board to meet the demand in the market. We've grown from 3 to 12 in very short order, and there's far more demand out there. So keen to keep it going along. The market's been very supportive. Our referral partners have been very supportive, and it's been a great opportunity. So looking forward to see continued growth in the market. I know there's a few headwinds as both Mark and Warren has spoken to, but agribusiness is not a single year affair. It's very much about being there through the cycle, and the businesses and operators are there through the cycle and tend to support them through that. Thanks.
Anyone out got any questions burning a hole in their pocket? Listen,
sorry, I'll jump in there before we close.
Okay.
What's the house view on credit spreads looking forward? And then second, what is impact on agriculture if rates go to, let's say, 7%, 2% above the cash rate?
Good question. I'll talk from a lender's perspective with not a whole lot of coverage across agribusiness spreads, but I think so what Warren mentioned around the water interest rates as a whole, and this has impacted credit spreads too. There's been factors in market that have resulted in a real compression. Like if you look at the cost of debt at privates through, or at the riskiest end of the spectrum, once you're starting to talk significant dollars, still single digits, which in historical terms that is really cheap cost of funding. And when I was in business, 15, 20 years ago, 10% for debt wasn't an unreasonable number. So, and the fact that you get that on for really non-compliant stuff, like there's been a very strong compression there, and part of that was to do with the fact that base rates have come down as much. The money printers were running, there's capital everywhere available, and people are seeking a return. I think you're going to start seeing that decompress. You're seeing the major banks, like their profit returns are probably not where people have expected them to be, in terms of where they're operating. And so with these, I guess the features like, quantitative easing, particularly low interest rates dissipating, you will see spreads bump out. That's my view anyway. I'm not sure if that's a house view.
Just on I don't think we're going to get to a 7% cash rate anytime soon. The economy will buckle before we get to that point. But if you go further down the track, 5, 7, 10 years, if my view that that's sort of where we're headed, or normalization or higher for longer, looks like that, and then we make those adjustments, the question becomes, what happens to credit spreads in that process? And I think you will see credit spreads be part of the process of normalization, and they might even be now. But effectively, it's going to be demand and supply for funds, whatever the RBA wants. And part of the higher for longer story from a macro fundamental point of view is that it's interest rate is essentially about balancing saving and investment within the economy. Now, it's obviously more complicated than that, but there's big features. And over the last 20 years with the baby boomers coming to retirement, we've had a lot of savings, and at least in the 10 years prior to the pandemic, investment was pretty soggy. And But we've seen the world change. We're going to start to see over the next decade savings drawn on. And we're going to see a lot of investment in tech and energy and climate. And a whole bunch of other things are going to get businesses investing, labor scarcity. And that balance will shift. So that's part of the higher for longer story. And that will mean that there'll be upward pressure on credit spreads too. It's essentially debt capital will get scarcer and scarcer every 5 years looking forward for the next 20 odd years would be my prognosis, and that'll put outward pressure on credit spreads. That's a medium to long-term story. That's certainly not relevant for the next couple of years.
Any other questions, folks? We might leave the panel there because I'd imagine that we're heading towards the point where everyone wants to get back in front of their computer and start their work day. So I guess on behalf of Paul Chadwick, I would like to thank our presenters today. And if we could, Warren, Anil and Mark, and if we could show our appreciation. I would also like to acknowledge Judo's support of this presentation today. And in particular, we'll thank Anil for stepping up at late notice. We were to be joined by the National or Managing Director of Agribusiness, Jason. I think he might be online now, but Melbourne's weather intervened. So perhaps we could give a special round of thanks to Anil for stepping up to the plate. Just on my behalf, I'd like to thank Jessica Webb, who obviously is one of our staff members who's helped us put this together. So I hope you got something out of that this morning, and all the best getting back to the office and getting back to the working day. Thanks very much.